If the economy is doing great, why does it feel like your money has holes in it? Jobs exist, inflation has cooled, and the headlines say things are fine. Yet so many households still feel squeezed, stressed, and stuck. In this video, we're counting down 15 reasons why the big economic numbers can look healthy while real life still feels hard, and how to spot what's actually driving the squeeze in your own budget. Number 15 is the first mind game. The economy is a set of averages, and averages can hide a lot. A strong economy usually means things like low unemployment, steady spending, and inflation not spinning out of control. On paper, those boxes can be checked while millions of people still struggle. In the latest jobs report for January 2026, the unemployment rate is 4.3%, and employers added 130,000 jobs. Inflation, measured by the Consumer Price Index, is running at 2.4% over the past year. Those are the kinds of numbers that sound like strong. But averages never ask the scary question, strong for whom? Because the labor market can be okay overall while some groups face much higher unemployment, weaker bargaining power, or fewer hours. Even in that same January report, the unemployment rate for black workers is listed at 7.2%, almost double the overall rate. And when the overall number is stable, it can still feel brutal if you are the one trying to climb back after a layoff, a pay cut, or a rent hike. Averages also miss the stress of being one emergency away from trouble. That stress can persist even when the economy is not officially bad. Number 14 is the most common misunderstanding. Lower inflation does not mean lower prices. Inflation is the speed, not the height. If prices went up fast for a while and then they start rising slowly, the cost of living is still higher. It just stops getting worse as quickly. The Consumer Price Index for all urban consumers reached an index level a little above 325 in January 2026. Back in December 2019, that same index level was about 257. That gap is why people still feel like everything costs more now. Even with inflation cooling, the price level is still dramatically higher than it was before the pandemic years. That is not a vibe. That is math. And this is why some people feel gaslit by the phrase inflation is down. What they hear is your costs should be down, but what the data actually says is your costs are still high, they're just rising more slowly now. Number 13 is the unfair part. The prices that rose the most are often the ones you can't easily avoid. The inflation report for January 2026 shows that shelter costs are still a big driver, and shelter was up 3.0% over the year. Food overall was up 2.9%, but eating out was up 4.0%. Energy overall was basically flat over the year, but inside that category you can see the weirdness. Gasoline was down, while electricity was up 6.3%, and natural gas was up 9.8% over the year. That matters because households do not all buy the average basket. If you rent, or if you have high utility bills, or if you rely on restaurants because of time, health, or work hours, your personal inflation rate can be higher than the national headline. And when the costs that jump are essentials, you can't fix it by cutting back on wants. You can skip a streaming service. You can't skip heat. Number 12 is housing, and it deserves its own spotlight because it sits on top of everything else. When housing is expensive, it makes every other problem louder. The American Community Survey one-year estimates show that the median gross rent in 2024 was about $1,487 per month, including utilities, and renters spent a median of about 31% of income on rent. For homeowners with a mortgage, the median monthly owner costs were about $2,035 in 2024, and the median share of income spent on those costs was about 21.4%. And here's the part many people miss. Those owner costs can include more than the mortgage itself. The same release notes that millions of homeowners pay condo or homeowners association fees, with a median monthly fee of about $135. So even if your interest rate is low because you bought earlier, other housing-related costs can keep climbing. Now look at renters. A major housing research center reported that renter cost burdens have been hitting record highs, and that in 2024, there were about 22.7 million cost-burdened renter households, about 49% of renters, paying more than 30% of income on housing and utilities. When nearly half of renters are in that situation, it changes daily life. It means fewer people can save. It means more people use debt for normal months. It means strong economy headlines can coexist with real, constant stress. And then there's affordability for buyers. Mortgage rates shape what a home costs each month, not just the sticker price. As of February 19, 2026, the weekly average rate on a 30-year fixed mortgage was about 6%. Even a small move in mortgage rates can swing monthly payments a lot, especially when prices are still high. This is also why the housing market can feel frozen. Owners who locked in very low rates often do not want to sell and take on a much higher rate, which limits supply and keeps prices firmer than people expect. And yes, supply is still a problem. One major housing finance researcher estimated that the United States was short about 3.7 million housing units as of the third quarter of 2024. Construction helps, but it has limits. The Census Bureau's construction data reports about 1,425,000 housing units were authorized by permits in 2025, and about 1,497,000 housing units were completed that year, which was below the prior year's level. When supply is tight for years, housing becomes a competition. And in a competition, the people with the most resources usually win. Number 11 is the cost of borrowing, which quietly turns everyday life into a monthly payment plan. A strong economy often comes with interest rates that are higher than people got used to in the late 2010s. In late January 2026, the central bank held its policy rate target range at 3.5% to 3.75%. That number is not what you pay directly, but it flows through the system. It influences what banks charge, what car loans cost, and what credit cards do to you when you carry a balance. Here's the brutal part. Credit card interest is not just a little higher. The Federal Reserve's consumer credit data, published via a widely used public database, shows that the commercial bank interest rate on credit card plans was about 20.97% in November 2025. When interest is around 21%, the debt can grow even when you are trying to pay it down. That's why people feel like they are working and still going backward. A raise can disappear into interest before it ever reaches your life, and debt levels are huge. In the Household Debt and Credit Report for the fourth quarter of 2025, total household debt balances were reported at about $18.8 trillion. Mortgage balances were about $13.17 trillion. Auto loans were about $1.66 trillion. Student loans were about $1.66 trillion. Credit card balances were about $1.28 trillion. And delinquencies matter because they are a sign of stress, not a moral failing. The same report said about 4.8% of outstanding debt was in some stage of delinquency at the end of 2025. When debt is that large and interest is that high, even small financial shocks can trigger late fees, penalty rates, and damaged credit scores that follow you for years. Number 10 is that the job market can look fine, while job quality quietly gets worse. The unemployment rate is just one measure. It does not tell you whether your hours are stable, whether your schedule is predictable, or whether your pay matches your bills. In January 2026, the labor force participation rate was about 62.5%, and the employment population ratio was about 59.8%, both little changed. That can sound steady, but steady does not mean comfortable. Here's one detail that matters. The number of people working part-time for economic reasons, people who want full-time work but can't get it, was about 4.9 million in January. And while it fell over the month, it was still higher than a year earlier by about 410,000. That is one of the clearest hidden struggle indicators in the jobs report. A household with a part-time paycheck and full-time bills lives in a constant mismatch. Another detail, the number of long-term unemployed, people jobless for at least 27 weeks, was about 1.8 million, and that group made up a quarter of the unemployed. Long-term unemployment is where savings disappear and desperation grows, even if the headline unemployment rate looks not too bad. Also, the pace of job growth matters. The same January jobs report said payroll employment changed little in 2025, averaging about 15,000 jobs added per month. That is a sharp slowdown compared with the boom years after the pandemic reopening. So the economy can still have low unemployment, while the job market feels less forgiving, less dynamic, and more anxious. People notice when it gets harder to switch jobs for a raise. They notice when fewer places are hiring. They notice when employers act like they have the upper hand again. Number 9 is that wages are rising, but real buying power is rising much more slowly, and not for everyone. The Real Earnings Report for January 2026 shows real average hourly earnings were up about 1.2% over the year, and real average weekly earnings were up about 1.9%. That is progress, and it matters. But think about what it means in real life. If your costs jumped hard over the last few years, a 1 to 2% real gain is not a catch-up. It's a small step forward after a big shove backward. That is why people can hear wages are outpacing inflation and still feel like they are drowning. Another wage measure helps explain why the vibe is still tense. The Employment Cost Index, which tracks labor costs while trying to remove the effect of job mix changes, shows that compensation costs for private industry workers rose about 3.4% over the 12 months ending in December 2025. Wages and salaries rose about 3.3%. And after adjusting for inflation, wages and salaries rose about 0.7% over the year. Again, positive, but small. If your rent renews at a higher number, if your insurance jumps, if your car payment is locked in at a high rate, that small real wage gain can vanish instantly. And there's a second twist. Even if average wages rise, you might not be average. If you are in a sector with weak bargaining power, if your schedule is unstable, or if you rely on tips that fluctuate, average wages can rise while you personally fall behind. Number 8 is the distribution problem. A strong economy can be real and still be lopsided. The Census Bureau's income data shows that real median household income in 2024 was about $83,730, not statistically different from 2023, and also not statistically different from the pre-pandemic year of 2019. That single point lands hard. It means that after years of inflation shocks and wage shifts, the typical household did not see a clear, statistically confident improvement in inflation-adjusted income compared with before the pandemic. So if you are thinking, why doesn't it feel like we're ahead? The median income data basically says, many households aren't. Now look at how uneven the gains were. In the same census release, household income at the 90th percentile rose about 4.2% from 2023 to 2024, while income at the 10th and 50th percentiles did not show a significant change. Translation: higher income households were more likely to see real movement, while the middle and lower ends were more stagnant. That creates a weird national picture. Restaurants can be packed in one neighborhood, while another neighborhood is living on credit cards. Both can be true at the same time, and the headline "Economy Strong" will mostly describe the part you see on social media, not the part you might be living. The same release also highlights gaps that affect real life. For full-time year-round workers, the female-to-male earnings ratio fell to about 80.9% in 2024. So even if the economy is strong, many women are still fighting a pay gap that directly shapes rent decisions, childcare choices, and retirement savings. And the data shows different racial and ethnic groups experience different income changes over that period. If you are in the group that did not get the gain, the strong economy narrative will sound like it's describing another country. Number 7 is that poverty is still widespread even in strong times, and the official definition of poverty is lower than many people think. In 2024, the official poverty rate was about 10.6%, and about 35.9 million people were in poverty. That is not a tiny fringe. That is tens of millions of people. Also, the Census Bureau publishes a supplemental poverty measure that counts more real-world factors, like taxes, certain government benefits, work expenses, and medical expenses, and it also accounts for geographic differences in housing costs. Under that supplemental measure, the poverty rate was about 12.9% in 2024. That gap between 10.6 and 12.9 is one reason people argue about whether the economy is good. It depends on what you count and what you ignore. Here's another detail people rarely hear in everyday conversation. The Census Bureau says the weighted average poverty threshold for a family of 4 in 2024 was about $32,000. If you've priced rent, food, childcare, or health insurance lately, you already know why many families above that line still feel broke. Poverty thresholds are not the same thing as able to live without constant fear. Number 6 is the two economies problem. One economy for people who own assets and another for people who mostly buy necessities. Household net worth is extremely high in the United States in aggregate. The Financial Accounts Report from early January 2026 shows household and nonprofit net worth rose to about $181.6 trillion in the third quarter of 2025, with most of that quarterly increase driven by gains in corporate equities. That is the strong economy you hear about when the stock market is up. But net worth is not evenly spread. The distributional financial accounts data show that in the third quarter of 2025, the top 1% held about 31.7% of total net worth, while the bottom half held about 2.5%. Read that again slowly. About half the country shares about 2.5% of net worth. That is why the same economy can feel booming to one group and punishing to another. And stock ownership concentration makes that split sharper. In the same distributional data, the top 1% held about half of corporate equities and mutual fund shares in the third quarter of 2025. So when equities surge, the gains are real, but the gains land heavily at the top. Meanwhile, if you do not own much stock and you are paying rent, rising markets do not lower your grocery bill. They just make the news sound upbeat. This is where the phrase "the economy" becomes slippery. A rising market can lift national wealth on paper without lifting your life at all. Number 5 is fixed costs creeping upward. Bills that do not care how careful you are. A lot of modern household spending is not flexible. It's locked in. Housing is fixed. Insurance is fixed once you choose it. Utilities are semi-fixed. Debt payments feel fixed once you carry balances. And then there are fees built into ownership that people don't think about until they hit. The census housing data doesn't just say owner costs rose. It spells out that those costs include mortgage payments, insurance, taxes, utilities, and various fees. That matters because taxes and insurance can rise even when you do nothing. You can be a responsible adult, pay on time, keep your home, and still watch the monthly cost creep. If you rent, you can be the perfect tenant and still get a renewal that forces you to move or downsize. This same fixed cost problem shows up in national saving behavior. The personal saving rate, a measure of how much disposable income households save, was about 3.5% in November 2025. That is not a moral judgment. It's a clue. When fixed costs rise, saving becomes what's left over, not what you choose first. If you feel like you are saving less than you should, it might not be because you got careless. It might be because there's less room. Number 4 is the debt trap that looks like convenience. A lot of modern spending is designed to feel painless at the moment of purchase and painful later. This is not about blaming people. It's about incentives. When money is tight, split it into smaller payments sounds like relief. But small payments stack up. They make it harder to see the total. And if your income is uneven, stacked payments become a calendar of stress. One major warning sign is the expansion of buy now, pay later products. A consumer finance regulator study found that more than 1/5 of consumers with a credit record used buy now, pay later loans in 2022. The same research found that many users had multiple loans at the same time, and about 1/3 had loans from multiple providers. More recently, that same agency reported that the market expanded between 2019 and 2023 and presented market metrics like loan volume, user counts, and late fees based on data from several large providers. You do not need to memorize the details to understand the core point. When households are squeezed, the market evolves to sell them affordable monthly bites. Those bites can keep you afloat for a while. They can also keep you from ever coming up for air. Student loans are another example where the macro story and the personal story clash. The household debt report for the fourth quarter of 2025 shows student loan balances at about $1.66 trillion. It also noted that the student loan delinquency rate remained elevated at about 9.6% of balances that were 90 days or more delinquent, tied to the resumption of payment reporting after the extended pandemic forbearance period. That's not just a spreadsheet problem. That's millions of people trying to restart a payment they didn't have to make for years, while everything else got more expensive. When policymakers say the economy is strong, the student loan borrower hears, then why is this still so hard? Now you know at least part of the answer. Number 3 is the fee economy. You are not imagining it. A lot of companies have shifted from charging one clear price to charging a base price plus add-ons plus fees plus suggested tips plus subscriptions. Sometimes these charges cover real costs. Sometimes they are just revenue. Either way, they make your monthly spending harder to predict and harder to control. And when spending is unpredictable, people feel poor even when income is decent. This isn't just talk. Regulators have been responding to the problem of hidden or surprise fees. The Federal Trade Commission announced a rule aimed at banning certain junk fees and requiring more transparent total pricing in specific industries, with the rule taking effect in May 2025. In air travel, the Transportation Department issued a final rule requiring automatic refunds when passengers are owed refunds due to cancellations or significant changes or other failures of purchased services. The details of these rules are less important than what their existence says. Hidden fees became common enough that the government treated them as a consumer protection issue. That tells you something about how modern pricing works. Now add tip screens into the mix. Many people now face tipping prompts in places where tipping used to be rare. Surveys have found growing public frustration with this. One national survey reported that many Americans say tipping culture feels out of control, and many are annoyed by pre-entered tip screens. This matters because tipping is not just an opinion, it is a budget line. When tipping prompts expand, they can make everyday transactions feel like social pressure plus extra cost. Even when you choose no tip, it can still feel like conflict. That emotional friction is part of why people feel the economy is worse than the headline numbers. The economy isn't just prices. It's how prices are experienced. Number 2 is measurement gaps. The official numbers can be accurate and still fail to match your life. That sounds like a contradiction, but it isn't. It's about what each measure is designed to do. The Consumer Price Index measures price changes paid by consumers, and the main CPI population covers urban consumers, which is most of the country but not everyone. It's a powerful tool, but it does not capture every financial pain point the way households feel it. Take housing. The CPI includes rent, and for homeowners, it uses a concept called owner's equivalent rent, which is meant to measure the cost of the shelter service a home provides, not the investment value of the house itself. The Labor Statistics Agency explains that spending to purchase and improve homes is treated as investment, not consumption, so it's not priced the same way in CPI. And interest costs like mortgage interest are not treated as consumer prices in the shelter measure. That's why people sometimes say, inflation is down, but my mortgage is brutal, and both things can be true. CPI is measuring a defined basket, not the exact cash flow pain of someone trying to buy a home when rates are higher. Now take shrinkflation, the thing people argue about nonstop. The Labor Statistics Agency has explained in detail how it tries to capture product size changes by tracking unit sizes and calculating effective prices per standard amount, so that smaller packages for the same price show up as a higher unit price in the index. A government accountability report also notes that downsizing can raise per-unit prices, but in aggregate its contribution to overall inflation over recent years appears small, while still being meaningful in certain categories and for real-world shopping behavior. The point isn't shrinkflation is fake or shrinkflation is everything. The point is that your frustration can be real even when the aggregate inflation effect is small, because you don't buy 1,000 categories. You buy the handful that matter to your family. If downsizing hits your staples, it feels big. Here's another measurement gap that hits people emotionally. Inflation is a rate, but your brain reacts to levels. When you walk into a store, you do not feel 2.4%. You feel, this is still way higher than a few years ago. The CPI can tell you inflation cooled, and your eyes can tell you prices did not go back down. Both are correct. Number 1 is the final layer: trust, memory, and confidence. Even when the data improves, people don't instantly feel better. There's a lag. If you lived through a period where prices jumped, savings got drained, and rent surged, you don't just reset your sense of safety because inflation slows. You stay cautious, you stay angry, you stay stressed, and that stress shows up in confidence data. For February 2026, the University of Michigan's Consumer Sentiment Index was about 57.3, up slightly from January, but down sharply from February a year earlier. That's not a small difference. It's a sign that people, as a group, still feel uneasy. And confidence is not only about today's paycheck, it's also about what people believe is coming next. If jobs are growing more slowly, people worry about layoffs, even if they still have a job. If debt is climbing and delinquency is ticking up, people feel like the system is fragile. If housing feels out of reach, people feel like effort doesn't lead to progress. If pay increases feel small compared with the price level jump since before the pandemic, people feel like the game changed mid-play. So when someone says the economy is strong, don't assume they're lying. They may be looking at real indicators. Inflation has cooled, unemployment is not high, and aggregate wealth is huge. But when someone else says, "I'm still struggling," don't assume they're exaggerating. They may be living in the part of the economy where housing eats the paycheck, interest eats the savings, and fees eat the rest. Both can be true at the same time. Let's recap the biggest takeaways. A strong economy can hide pain because it's built on averages. Inflation can cool while prices stay high. Essentials like shelter and utilities can rise faster than the headline number. Housing is a budget bulldozer, and the country still faces years of supply and affordability stress. Debt matters more when interest rates are high, and credit card rates around 20% can turn a tight month into a long-term problem. Wages have been rising, but real gains are modest and uneven. Income gains and wealth gains are not shared equally, and asset booms help people with assets far more than people without them. Fees, subscriptions, tipping pressure, and pay-later products make budgets less predictable. And even when the data improves, confidence takes longer to heal because people remember the shock. If this helped you make sense of the disconnect, like the video, share it with someone who's tired of the same old arguments, and comment with one specific thing that has hit your budget the hardest since before the pandemic: housing, food, utilities, childcare, debt interest, or something else. And if you want to follow up, tell me your biggest monthly pressure point and what country and state you live in, and I'll break down what the data says about that exact cost.